So we're talking about the money supply process, and we talked about how the Federal Reserve System is structured, and we spent some time talking about the Federal Open Market Committee and how the Federal Reserve, through its banks and through the FOMC, um, has a control over the monetary supply. We said that in order to expand the money supply, Fed can reduce the discount rate and buy securities through open market operations, and then they could also lower the reserve requirement. And just the opposite, in order to contract the money supply, um, like what they are doing right now, they could increase the discount rate. They could sell securities through open market operations, and they could also increase the reserve requirements. So today and Friday, we'll talk about how we are doing this. And I really don't want to talk about accounting of things. However, there's a little bit of um, a process that involves multiple banks. So even though I actually put them on a little T account, they're really just for illustration purposes, and I don't have no intention of involving accounting into explaining the money supply process. Um, it is important to understand that the system involves four parties. We have the Fed, we have the banks, deposit institutions, and then we have the consumers, retail, you and I, and then we have the borrowers. So if we have if the individuals do not spend money, or they do not borrow money, or they do not involve their money with a deposit institution, meaning we just keep it as cash, then the money supply process stops. If the businesses do not borrow, then the money supply process stops. So a healthy economy needs all four participants of the money supply process. And that's why sometimes, while the Fed has control of the monetary base, they do not have complete control over how the banks want to, keep excess reserves or not. They do not have control over whether businesses want to borrow more or not, whether the consumers will choose to save or spend or not. And therefore, while the Fed may be doing everything right, their intended operation may not fulfill its purpose. It's always a they will do a little bit, and then they will have the feedback from the market, from the economy, and then to see if what they're doing is working, and then based on that, they will continue, they would slow down, they would increase, just as they have been doing for the past year with the fight with the inflation. They've increased it quarter of a percent, and then three-fourths of a percent, and then another three-fourths of a percent, all the way up to 5%. And then they got the feedback from the economy, and based on that, they stopped increasing the interest rates, and they're just listening how the economy is responding. So it's never a robotic process. It's never, if we do this, this is what's definitely going to happen. It is a process of providing a little bit of motivation to the monetary supply process, and then seeing if you actually get a response. And the response can be healthy, in which case you serve your purpose, but the response can be slow, and therefore there needs to be other measures that need to be done. So it is always a process of, on one side, the monetary policy, and therefore the Fed. On the other, you have the government stimulus with respect to economic activity, business activity, taxation, government spending, and obviously we also have subsidies. Um, you know, the government can actually interfere or intervene with the economic activity through its regulation as well. So having said that, let's talk about how do we expand the money supply. And again, we talked about these different kinds of monetary base, the M1 and an M2. And just to remember, the monetary base is the reserves and what the Fed has in their um, controlled. M1 is the money in circulation, and the checkable deposits up to $100,000. And an M2 is M1 plus a little bit longer term. And higher amounts. So having said that, let's talk about how to create money. So to begin with, we need to define that when we say let's print money, we don't mean let's create banknotes. We are creating or we are expanding the money supply. So creation of money perhaps may not be the best term to use here. We are expanding the monetary supply. So we start with the central bank. In our case, um, it's the Fed, and the central bank has assets, securities, loans to financial institutions, and then they have the liabilities as currency in circulation and reserves by deposit insurance. So now let's actually create an example bank A, right? So with the bank A, well, maybe I could just copy this right here. With the bank A, what we now have as assets are we have securities, we have reserves, and we have excess reserves. And we have loans and loans to clients. Right. I want to make sure that we're talking about loans in respect to a bank. It's the loan that we actually pay out. And therefore, this is an asset. For a corporation, loan is something that you borrow. For a bank, loan is something that we lend out. So loans to clients or customers. And with respect to the liabilities, for a bank, that's usually deposits. And if they have any bonds or preferred stocks, any sort of liability. But for our purposes, we'll keep it as deposits. Now, remember, the banks usually don't like keeping excess reserve because you simply do not earn anything out of it. And therefore, anytime we actually have reserves, that's required. And anytime we go over that requirement, we're basically keeping idle cash for nothing, right? So the process, in fact, let me actually do this. Let's put it to the right, and then let's do this to the right as well, to the left. So when the central bank says, I'm going to be buying securities from you, what will happen is, let's say for $1,000, when the central bank buys securities from bank A, the amount of securities the bank has will go down. In fact, let me actually put all of these to the left. That's five. So, and as soon as this is done, the reserve now will be up by $1,000, meaning the Federal Reserve or the central bank will buy the securities from you and then will deposit the $1,000 into your reserve account. Now, we now have a little bit of an issue, if you notice. We have the security reduction and the reserves, and which means now we can actually loan money to clients because now we have cash in our reserves. Unwillingly, by the way, but nevertheless, this actually becomes an excess reserve, actually, right? Because currently we do not have deposits. So to begin with, this actually goes to excess reserve because we don't have any deposits that correspond to that reserve. And therefore, what we want to do is we want to utilize that reserve and we want to give out a loan, right? So as soon as we give this loan out, what we're going to do is we will deposit our client's account for the amount of loan that we give him or her. Now, as soon as we do that, the issue now becomes the excess reserve, right? But I mean, just remember now that let's assume, for an example, that the reserve is 10%. Let's just say, what happens now is the excess reserve will be $900, and then the actual reserve will be $100, right? So let's do that again. When the central bank buys $1,000 worth of securities from us, we immediately get $1,000 in our excess reserve, and because we don't have any deposits. Now, what we want to do is we want to utilize that reserve. So what we will do is we are going to loan $1,000 to a client, and it doesn't have to be $1,000, obviously. It could be something significantly more. But for this example's sake, we're going to loan $1,000 to a client, to a customer, and once we actually start the loan, we will immediately deposit his account with us. We give a loan, we put $1,000 in his account. That's it. Now, as soon as we put that $1,000 into the account, now we have a reserve requirement of, as an example, 10%, that's $100, which means that our excess reserves now are going to be $900. So this amount will go down to $900. So if you look at it, this actually balances out. So this is negative 1,000. We sold the securities to the Fed, or the Fed bought the securities from us. We didn't sell them. The Fed bought them from us. That created a total reserve at $1,000. At that time, we didn't have any deposits, so all of it was excess reserves. Then we decided to pay out a loan or lend money, and said let's lend $1,000, which becomes our asset. And as soon as we lend the money, we put the money into the deposits. So that's going to be $1,000 of the deposits. And as soon as we put the $1,000 in, now we have a reserve requirement of $100, and our excess reserve will go down to $900. So these balance out, and we have $1,000 right here, $1,000 right here. So we have a balance. So notice, by the way, that as soon as the securities are actually bought by the Fed, because our reserve requirement is 10%, we could have actually lent more money, right? So our securities are, this example, bound by $1,000, and we loan to clients about $1,000, and we now have a deposit of $1,000. So now the interesting bit, what can happen to this deposit is that the borrower, can actually withdraw this money. And let's say that this particular borrower withdraws this money, goes to bank B. I mean, think about it. You actually borrow from Chase because their interest rates were good, but then you actually have an account with Bank of America, Capital One. So what you do is, as soon as you borrow, they put the money in your account. You actually go withdraw the money, and now you go to your own bank and you make a deposit, $1,000. And now, as soon as you do this, by the way, for the bank B, the reserve requirement is 10%. And notice that since they still have the $1,000 as a deposit, and they have a reserve of $100, that's the 10%. Now what they can do is they can actually create a loan to another client as much as $900. Right? I mean, it's not, notice how this is 1,000, this is 1,000. So now let's go back. Central bank, securities, loans to financial institutions, and the liabilities are currency in circulation reserved by deposit. So our intention as Fed is to expand the monetary supply. We want to create money. And what we did is one of the tools that we have is we can buy securities through open market operations. And that's exactly what we did. We bought securities from Bank A worth $1,000. And then we put the cash in their reserve account. Now, obviously, at the beginning, they didn't have any reserves and they didn't have any deposits. And therefore, all of the cash that we put in as Fed became excess reserve. But then the bank actually loans the money to a client, puts the money as a deposit. And as soon as the money is in the deposit, 10% reserve requirement becomes due. So $100 goes to reserve. And then of total, $900 becomes the excess reserve. Now, the client whom we lent the money to now can withdraw that money, go to another bank, and deposit the money. So that $1,000 comes to Bank B. Now, as Bank B, now what I can do is, what I have to do now is I have a 10%, as an example, reserve requirement. So I put $100 into my reserves, and now I have $900 spillover of the money that came as deposits, and I can actually loan it to another client. It's very simple, right? So then let's look at Bank C. So let's say that this time the money is lent to another client, and this client actually withdraws the money again, and now that $900 goes to deposit to a third bank. In this example, is a Bank C. Now, as soon as this is done, 10% reserve requirement as an example. So what will happen is this time we actually need $90. That's the 10% off the $900. And we can actually have loans to clients as much as $810. See, that's 900 and that's 900. So notice how this actually can keep going. I'm going to go a couple more times, but everything actually started out with that initial security buy off the Fed through their open market operations from one of the banks, and that led to this bank loaning that $1,000 that they received as receipts off that security sale, and then depositing the money in their client's account. Now, remember what I said, that there are four parties to this money expansion system process. And that's the Federal Reserve, as you can see, they bought the securities, and then the banks, deposit institutions, and notice how this is where they are. And now the customers, clients, and deposit holders, and then the people who borrow, the institutions. Now, notice if at this point, whomever actually borrowed the money, they leave the money in the account as cash, the money generation process actually stops. There really is no more. A $1,000 has been created and or has been given into the system, and that's it. There is no more than $1,000. However, if the retail and the institutions who borrow the money withdraw the money and put it in another institution, then there's a 10% reserve requirement, and then now another $900 can be lent out. And again, if the client wants to keep the money in the account, then the money stays in the account and the money creation stops. However, if the client wants to withdraw the money and put it in another institution, and remember, we have about 5,000 of these institutions in the US, then the $900 goes to the Bank C, 10% reserve requirement, and then we have $810. So let's do another bank. Let's say Bank D, and this time, obviously, remember we have $810 it can be net loaned out by Bank C. So if the client actually withdraws that, what they actually borrowed, then there will be $810. The reserve requirement will be $81. And then you're going to have $810 deposit minus the $81 of the reserve requirement. So you're going to have a $729 of more money to create, right? So the idea is actually quite simple. This actually continues very much. I mean, we can do another one very simply. If we go to bank E, as long as the consumer, the people who are borrowing the money, keep withdrawing the money, and the process continues. So you're going to have $729, and then you're going to have a reserve 10%. That's going to be $72.9, and then 729 minus the reserve of 73.9. That leaves you 656.10, and that will be 656.10, and that will be the loan that can be paid out by the fee. So just to show you, what can happen if you go from bank 1, and then bank 2, bank 3, and so the first bank, they actually have increasing loans, and so maybe I should actually start with bank, right? So bank A, right? So the first bank will create about $1,000, and then the next one, and then the next one will be creating about 10% less, so that will be $900. And then the next one will be creating 10% less. So this time 90%. And then the next one will be creating 10% less, 10% less, 10% less, 10% less. And this will continue. Right? And then we're going to have a total that will be about 10 times the overall amount. And that's 10 times because of the reserve requirement is 10%, right? So now remember, if the system is complete, then that's how much maximum you can actually generate with this one single purchase of the $1,000 that you started out with. And it's a simple process, as central bank simply buys $1,000 worth of securities from one bank, and the impact of it could be about 10 times that. Now, if they buy $1 billion, then you expect $10 billion of money creation. Now, it is a complex, but it's a simple process, as what Fed is doing is very simple. However, it's a complicated process because every time all of these banks that are involved in the process, they need to actually set aside reserves and then lend the money out. Set aside reserves, lend the money out. And then anytime the money is lent out to an individual or an institution, they need to withdraw the money, put it in another bank. And that assumes the integration of all of the banks, and that assumes the consumers will be withdrawing the money all the time. That also assumes that the financial institutions will be lending, the money all the time, and they won't want to keep any excess reserves. And therefore, it is an imperfect system. And in a utopic world, you would actually have $10,000 creation with $1,000 tenfold. And that tenfold is because we assume that the reserve requirement was 10%, right? So now also remember that you said, what if we actually lower the reserve requirement, right? Let's see what sort of an impact it would actually have. Now, going back to our original, so if this is the case, right, and start with this bank, and then remember now that initially you could actually go, let's save time, and instead of going through this one more time, let's go through this. And instead of starting with 1,000 and then 900, so now we are going to be able to lend out 95% of this instead of 90%, right? Because we reduced to reserve requirement from 10% to 5%, and we want to see what sort of impact it will actually have. So if we actually continue doing this, notice that each bank, how much they can lend out is a little bit higher this time compared to what it was for 10%. And the total will be 20 times more than it will be about 20,000, right? Because now it's not the tenfold, it's not the one, the 10%, it will be approximately 5%, 20-fold. So this is the money creation process or the expansion of the money supply. And the idea always is to, the hope for the best from a Fed perspective. However, it's an imperfect system. And unfortunately, sometimes banks will choose to have excess reserves. Individuals may choose to have more savings. And institutions may choose not to borrow. And interest rates may be too high. And that's why a lot of times when you look at the financial information, things such as housing starts, mortgage applications, these carry a lot of weight, and because they also are indicators of money creation or money supply process. And more people buy homes, more borrowing, and more long-term borrowing, and more borrowing means more money supply can be expended. Now, if we wanted to contract the money supply, we do just the opposite. We actually we can increase the reserve requirement to 5% to 10%, or we can actually sell securities to open market operations. So instead of doing a security going $1,000 negative, meaning Fed buying them, if Fed were to sell them, then our securities would actually be positive, in which case we will have a reserve. Well, and then our deposit will go down to, and what will happen is as soon as that happens, our reserve will be -1,000, which means we have to put money into our reserve as a bank. And in order to do that, we may have to lower the amount of loans that we have, or perhaps more loans back. And not only we don't have any excess reserve, but now we have a negative reserve account, which cannot happen, and therefore we may need to borrow money to pay this reserve, or increase our deposits somehow, and then pay this reserve. And somehow we have to get that money. As a bank, for us, get that money means we have to draw that money from the economy, from our asset base, and then pay it into our reserve account at Fed. And that's how the money supply process contracts. So anyhow, on Friday, I'll review this shortly, and then continue with how the process works, and the kinks that we need to talk about. And there's also the international aspect of this, especially when it comes to the US dollar with respect to the international reserves. But anyways, thank you so much for working with me. I really do appreciate it. And I do hope to see you guys soon. And please let me know if you have any questions. Thank you. Bye for now.